Hello students and welcome. As you know, India is dreaming to become a $5 trillion economy. In order to achieve this goal, India has taken one more step further, and that one more step is to consolidate the public sector banks or the PSBs. Before we get into the details of this topic, let us understand the meaning of consolidation. So the meaning of consolidation says that the small public sector banks would be merged into bigger public sector banks, the stronger public sector banks. For an example, SBI Group would contain Bank of Maharashtra, UCO Bank, Punjab and Sindh Bank. Another group would be Canara Bank, which would include smaller banks like Union Bank of India, Indian Overseas Bank and Bank of India. Last but not the least, the Punjab National Bank would contain Bank of Baroda, Central Bank of India and Indian Overseas Banks and so forth. But the question is why there is a need of consolidation. So the consolidation is needed because there is a term known as recapitalization of banks. What is the meaning of this? As we are aware that the Indian banks are facing a typical problem of NPA, which is the non-performing assets. That means people taking loan and are not repaying the loan. So banks are getting weak, their balance sheets bleed. So in order to solve this problem, government give them the support. Sometimes they are given the money, they are given the loan, and this is what you call the recapitalization of banks. Imagine if banks are huge, they will not be needing money from the government, and ultimately government is paying the money to the banks with the taxpayers' contribution. So taxpayers' money would be saved. So the consolidation would help the Indian banks to run globally, to compete with the big global banks. So very soon we are going to see bigger, stronger and confident banks. Thank you very much.